The hedge fund industry on track for net outflows this year, and if things stay on course, it'll be just the fourth time in 14 years that that's happened. Leslie Picker following the money, as always. Good to see you.
Good to see you too, Scott. Now, largely, this is October to thanks for these outflows because we saw $7 billion redeemed in net redemptions from hedge funds in October alone. And oftentimes, at least according to eVestment, where these numbers come from, you can see a lot more outflows in November and December. So that trend isn't really likely to reverse itself by the end of the year. They're projecting that this is the fourth time since 2004 that we could see net outflows. And that's largely thanks to performance. These things follow performance, and the performance has not been good in October and November.
Not much of a surprise, Mr. Weiss?
No, the outflows aren't. And as I mentioned before, I talked to tons of family offices. They're my investors, large single-family offices. And I'd be hard-pressed to think any of them that are willing to put money into hedge funds at this point. They're taking it out. They're going private equity. They're going direct. Look, this was the year hedge funds, or this was the quarter hedge funds were supposed to do well, outperform the peer group, the long onlys, because give you that downside protection. That's what they're paying. That's what you're paying 2
That's what you're paying for, right?
Right, and you're not getting it. And
you did this month, and you have year to date versus global equities.
Well, you're still down. You're still down on the year, and I think that you still got too much excess capacity in the industry. And there's still too much of a love affair with the largest managers who just aren't nimble enough to capitalize on it and can't find the short book. So I still think there are troubled waters for hedge funds ahead. It's not going to be easy. You've got to see some more liquidations.
So we started increasing this year. We've been very underweight because
increasing exposure.
2 hedge funds late last year, early this year. We've been very underweight hedge funds for a long time. We had the notion that we were going to get into an environment where dispersion, both across assets and intra-assets, was going to pick up. That's typically an environment that's great. Rising rates, the 3 last rate hike cycles, hedge funds outperformed. Our average portfolio of hedge funds is up 7% year to date. It's been incredibly.
What type of hedge funds are you in?
We've been doing multi-strat, relative value. Things that are diversified. I think long short's a little tougher.
Long short equity is very tough.
Most coming out of quants.
Most of them are coming out of multi-asset, actually.
Quants have actually done well. We have some allocation to quant
after a rough spot. After a rough spot. Quants just picked up so much capital. I'll never forget, 2 years ago, I was in a meeting at JP Morgan, a hedge fund meeting, and the room was overflowing with quants. They were superstars. Whereas the year earlier, there was nobody in there. It was me and 4 others.
So, Weiss, this is classic. I mean, fees, taxes, performance, and liquidity are the drivers of the move. What you have to understand is we were in an environment that was consistent for a long time, where there was high inter-asset correlation. We are in a different environment now, and I will tell you that I'll accept beta all day long, low-fee beta, tax-efficient beta, for an investor that is really long-term and can tolerate that volatility. The truth of it is most investors do look at their statements. And at the end of the day, if they see that volatility, they can get shaken out of whatever their goal-based strategy is. So including hedge funds is just about smoothing the path to travel.